Good evening, everyone. It's Chris Smith from the Option Club. I just want to check real quick that you guys are able to hear me. So if you can just type something into the question box that shows me that you can hear what I'm saying, that's great. I see the yeses coming in. That's good. Tonight, Mark Sebastian's back with us, and will be talking to us more about the VIX and related products. And if you caught the first presentation, you realize it's pretty heavy-duty stuff. So we did need to break it into two sessions. And with that, I'll turn the reins over to Mark. And Mark, you should have the comm now.
Yeah, I got it. Good to see everybody. How's everybody doing today? Hopefully well. Yeah, this was fun. I was going through putting this thing together, and I think there's going to be a lot of really interesting things to look at. We're going to talk about kind of all the different products again, but today we're going to talk a lot more about VIX options and a little less about some of the other products, which I think many people are really interested in anyway. Last time we learned how the VIX is calculated. We learned about we talked about the fact that the VIX really isn't that accurate. Some of its foibles with naturally falling on a rally and naturally rising when we fall. Some of the problems that it has with weekend time decay. All right. We learned about problems with the VXX, and I kind of went through why I think it's going to zero, which I certainly do. Then we talked about whether the VIX is really an effective gauge of volatility. We learned about the VXZ, and we discussed VIX futures. And by the time I was done, everybody was saying, "Wow, Mark, this is intense stuff," and I was very pleased with that. All right, today we're going to learn about the VIX options. We're going to learn how to calculate a synthetic future. All right. We will briefly discuss VXX and VXZ options, and then we'll compare VIX options to unit hedging strategies. Okay. Do we all remember what a unit is? I think that was one of the first things I ever talked about for you guys, right? Was in a crisis by having those extra puts. So we're going to compare, whether you can use a VIX option as opposed to a unit as a hedge, and when it may be appropriate. We'll talk about that. All right? All right, the VIX options. All right? The VIX options are a futures-based product. This is the number one thing. I write for The Street, a daily column, and I was shocked to learn that, some of the writers that I was working with didn't understand how the VIX options were formulated. They were getting bad volatility numbers, think or swim. Everybody here loves think or swim, I'm assuming, right? Chris, what would you say? 90% of you people are think or swim people?
It's a pretty big percentage.
Yeah. Think or swim miscalculates the volatility of the VIX options. All right? And I'll get into that. All right? They have irregular expiration cycles. Okay? They're very strange. All right? And as I was saying, they often have the wrong volatilities. All right? And they're one of the most mistraded products. Just people thinking it's a cash-based product. People thinking this. People thinking that. You would be shocked how often I see that the option's mispriced. All right. So does that mean you shouldn't trade the VIX? And the answer is no. I hear so many different people coming in being like, that talk. Some of these guys, some of these so-called gurus, oh, stay away from the VIX, or don't go near the VIX, or whatever. Here's the thing. Something that's hard to trade usually has edge in it. All right? And when I say edge, that means a profitability, some chance at profitability. Okay, there is some real, quirks to the VIX options, but that can make them a more profitable trade, especially if you trade them well. Okay, so if somebody tells you not to trade an option, they're either too stupid to teach it, ignorant, or they're trading it themselves and making a lot of money. All right. Most of the times it's number one, and number two. When I was on the floor, it was always number three. I was, famous. I used to be a famous sandbagger back in the day. I'd be trading in a pit, and I'd have a product that was going poorly, and someone would say, "Should I trade that?" And I'd say, "No, it stinks." And then I'd have a product that I was making money in, and people would say, "Well, should I trade that?" And I'd say, "No, it stinks." And that was because I didn't want other people trading my products. All right? I wanted less competition. I know it sounds horrible, but that's just the way it was. I want a bigger piece of the pie. It's like, you've only got so much order flow going through, so many customers trading one product. Every person that comes in takes a little piece of my pie. I don't want to share my pie, So, but more often than not, it's that these guys just don't know what they're talking about. All right? Any questions so far? Good. I'm assuming no. All right. Trading the VIX. All right? There is a 4-step strategy to trading the VIX option. All right? 1, establish where the underlying is trading. Okay? This is the first thing. Remember, the VIX options have nothing, almost nothing to do. That's not true. They do have something to do with it. But they have almost nothing to do with where the cash is trading until the final couple of days. Okay? I think we went over that the last time. I kind of walked through the futures actually kind of have a weird decay to them. Okay? All right? And so you've got to figure out where the underlying is trading. All right? And you do this by calculating a combo for that given month. All right? Next, figure out when expiration is. And you're saying, Mark, I need to figure out where expiration is? And the answer is yes. It is really, VIX options expiration is really confusing. All right? Then you need to examine the contango, or backwardization, I should say. Okay? I'm going to change that. I'm going to add the little or backwardization. Backwardization. That's a big word, isn't it? Backwardization. All right? And then finally, develop a strategy. All right? Now, what I'm going to do for you guys is I'm going to take you through step 1, 2, and 3. All right? I'm going to leave step 4 to you guys. All right? Or if you come to my AM pit report, we'll talk about that stuff a little bit. All right? All right. So let's take a look at this VIX montage. All right? Take a look. All right? This is from today. Guys, where did the VIX close today? Anybody? Bueller? Where'd the VIX close? This is an easy one. This is not a trick question. All I want is the closing price of the CBOE Volatility Index.
Ray's telling us it's 1909.
Okay, good. All right, so the VIX closed 1909. I'm going to, if that's Ray, I better double check. No, I'm just kidding. Yeah, I think the VIX, the VIX closed 1909, dead on. All right? I thought it was something like that. All right? Now, the thing is that this is the November contract month, as you can see. And the 19 strike is not the at-the-money option. Okay? That is not where the underlying is trading for the VIX November option. All right? The most obvious way to tell that this is not the at-the-money option, pull up an at-the-money option in, let's say, SPX. Okay? SPX closed 1185. All right? And here's November. Take a look at the values of the November 1180 calls and puts. Okay? What do you notice about those prices, guys? They're pretty close to the same price, right? I mean, I would call, the 1180s puts and calls as trading about the same level, wouldn't you? And a little bit off on the 1185s. Those are touching the money. It must be probably an interest rate thing. It's a cost of carry thing. Okay? Right? Now, if we pull up this VIX, wrong. If we pull up this VIX montage, do the 19s even look remotely like the same price? Not even close, right? Now, if we look up, we can see the 22.5s are kind of close. The 24s are kind of close. All right, so that can give us a hint as to where the VIX future is trading. Okay? Because you remember, it's not really easy to find VIX futures, the prices. And when you look at a option montage, nobody gives you where the underlying is trading. Okay? I mean, look, I'm going to pull up Thinkorswim. All right? And, take a look at the, when I type in VIX, is where the future is trading anywhere to be found in this November montage? No. In fact, Thinkorswim, you can't even get a futures feed in Thinkorswim. All right? The other problem is that, like I said, I'll get into this, but Thinkorswim doesn't look at the volatility properly because they use the cash. The cash is not the right thing to trade. All right? All right, so we're going to create a synthetic VIX future. We're going to use put-call parity. So call minus put equals futures minus strike plus interest minus dividends. All right? Since this is a derivative on a future, thus a derivative on a derivative, the I minus D can be dropped in the short-term trade. All right? If rates are ridiculously high, or if you're going way, way out, there can be enough value in the actual options that you have to start adding that stuff in. All right? Now, there's no D for the VIX options. They don't pay a dividend, so that's not something you have to worry about. But the interest rate portion can come into play in certain circumstances. All right? Thus, if I wanted to calculate the November future using the 20 strike, it would look like this. Let's just go back real quick. Everybody write down the bid-ask spread is 380, 410, and 65.80. All right? So the call is worth about 395, right? 380, 410, I would call that mean 395, wouldn't you? And the put is trading about 72.5 cents. Our strike is $20, and we don't know our futures price. Well, I can run through the algebra if you guys really want. But basically, 395 minus 0.72 minus 72.5 cents equals question mark minus 20. When you do the algebra, it comes out to 23.22.5. All right? So, I'll quickly run through. Let's pull up. We'll use Thinkorswim. And let's do somebody pick a month. What month should we do? You want to do January? All right, we're going to do the January contract. We're going to find out what the January future is trading. I didn't do this the last time I was here, right? I only did this for my students, right?
I think this is the first time.
All right. I do this a lot of times. I do these things for my students a little ahead of time, or I'll preview things for my students. So sometimes I get confused as to what who I've spoken to about what. I'm sure I'm sure you guys have all had some sort of experience with that. Call is $8. I'm going to make that a little nicer looking. Call that $8 and 20 cents. Sure, we'll call it $8.20. Close enough, right? The put is 45. And of course we're using a strike of 20. So if I'm doing the math, 820 minus 45 equals our future minus 20, and we drop the I minus D. So then it's 7, it's 775 equals F minus 20, and then F equals 2775. All right? Now, if we want to go figure out, if you don't believe me, whether that's effective, let's pull up the Chicago Futures Exchange. By the way, guys, if you aren't using Google Chrome, this thing rules. I love Google Chrome. It's so fast. Although now it's not for some reason. What? All right. There you go. Well, you can see the Jan future closed 27.70, and the November future closed 23.25. I would say a nickel and 2.5 cents is probably close and is pretty darn close, don't you think? All right, certainly close enough that we can figure out exactly where things are trading. All right. All right, now that we know where the at-the-money option, all right, if you know where the underlying is trading, then you can, that's the first step in kind of understanding the, how the product is trading. All right, now, step 2, okay? Short answer, go to the CBOE website, use their spreadsheet. I'll show you this thing. It's ridiculous, all right? The long answer is, it is the Wednesday that is 30 days prior to the Wednesday before expiration. All right, I think. All right, you need to know this time frame, so you need to understand when your stuff is expiring. Okay, so if we go to the SIBO Volatility Index Futures, we can find last trade and settlement dates. Let's see. Here we go. Oh, here's the awesome, this spreadsheet. They literally had to write up a spreadsheet for the VIX. All right. Pick out a year, Chris.
2010.
All right. Wow. All right, now contract month.
December.
All right, I know I went through this, right?
Yeah, you did.
All right, and you know you can see when December expiration is going to be, and know that the options. All right, if you go to the SIBO website, that might be on here. I'm gonna look. No, they are not. I mean, that's just unbelievable that they need that. But that is how you know when the options are expiring. Just take a look. The options don't expire until, you know, tomorrow is the last trading day, and then there's a special opening print on Wednesday morning. Okay? And people totally screw with it, so don't ever stay into this expiration. I mean, they totally game it. It is, the way it is calculated is so unbelievably gameable. The only thing that they really do game, all right? But you can see, similar to a regular index, this is going to trade tomorrow, and then on Wednesday morning it's going to expire into cash. Okay? And that is 30 days prior to the Wednesday before next month's expiration, I believe. So, you know, go fig. All right. Now, step 3 is the contango. All right. And this is why you need to know this. All right. Believe it or not, the futures actually, due to this kind of general contango, have a kind of decay. Okay? So what happens is that, you know, the further out in time, the more people, certainly right now, the further out in time we go, the more people are kind of afraid of what's going to happen. All right, so I'm going to put out a line, and we're going to put out hash marks for the time frame. Do we have any questions so far?
I think we're okay.
Good. Don't worry. Feel free to ask questions as I'm going through this. I feel like, all right. So this is going to be price. All right, and this is time.
Yeah, Mark Earl's asking, are we in the November expiration now?
No, October expires tomorrow on Wednesday. All right. So here's Jan. So you're dealing with a May option. All right, or yeah, we'll say a May option. All right, and here's May. All right, and here is VIX cash. It's right here. All right. So what happens is you have Jan, Feb, March, April. All right, and what's going to happen over time, what color should I use, Chris? What do you think? Blue?
I like blue.
Yeah, I like blue. I'm a big blue fan. So, not Michigan, don't worry. I'm not that big blue fan. So here's kind of where the May future is in January. As time passes, it slowly creeps toward, you know, it kind of slowly creeps toward before it hits May. It actually does speed up in this final week. But it's this slow creep. So believe it or not, you have two types of decay when you're dealing with VIX Options. And this is what makes them so unique and interesting to trade. All right? Because you're actually dealing with a multi-dimensional surface. All right? And this is why certain types of strategies can be a lot more difficult. And certain types of strategies can be really good. All right? So, you've got this kind of slow decay in the futures. And then, what other decay do we have besides futures decay, guys?
We got one question here asking whether the decay accelerates.
Yes, yes. In the final week, it really starts to head toward the cash value. All right? All right.
And then we got a couple people saying that the other type of decay is time decay.
That's correct. So you've got time decay and time decay. So it's kind of cool. You're dealing with a three-dimensional product, which means that, you know, if you have a long-term outlook on volatility, you can really set up some advantageous trades. Okay? You know, if I was a long-term bear of volatility, okay, if I think volatility is really going to fall long-term, do you think there's something, an advantage to the fact that I can set that March 2011, the at-the-money option is trading $30? I mean, let's think about that. I've got two decays then kind of in my pocket, okay? If I sell this credit spread at 30, which is the at-the-money option, we know right now, if all things remain equal, what's going to happen to the VIX, to this March 30 call spread. All other things equal. It's going to head toward, come on guys, this is easy.
We've got people saying the question is not clear. Someone said, please repeat.
All right.
I think we've got people befuddled.
Nice word. No, all right, so we've got this multi-dimensional decay. We've got the decay in the futures and the decay in the options. All right? So if I have a long-term bearish opinion on the VIX, okay, what advantage is there to me to sell an at-the-money option, which has the most decay, right? At-the-money options have the most time premium. What advantage is there of mine to sell at-the-money options in kind of back month areas, all right? Like March or in Feb or in Jan. What's kind of the advantage there? What is going to happen to the VIX, all other things being equal? What's going to happen to the March, the kind of March future, all other things being equal? If the cash index stays around 20, what's going to happen to the VIX, the March VIX future as time passes?
Got a couple people who've said zero. Depreciates.
Okay.
We're starting to catch on now.
Well, what's going to happen? Yeah, they starting to catch on now?
I think so.
All right. Well, what's going to happen is you throw on that March call spread, even if, you know, as time passes, that March option is going to have that decay going in your favor. So even if volatility kind of stays the same or increases, okay, a little bit in the cash, you're going to be able to take advantage of this kind of multi-dimensional decay. So you've got the theta of the options and the decay in the futures working to your advantage. It's a really kind of an interesting concept. It's complex, but if you take, and certainly do not trade it based on this course. You need a lot more than just this. But if you really do your math, I think you guys will, and really do your research, you start realizing there's some really advantageous things to taking some bearish opinions, especially when there's this kind of ridiculous futures contango. All right? Does that make sense?
Clifford's asking, does this assume that the at-the-money option does not change?
The at-the-money option does change, but the neat thing is, the neat thing is, here is you sell an at-the-money call spread in IBM. If 30 days passes and IBM doesn't move, yeah, you collect some decay, but you know what? You haven't made any money off of your delta, okay? If you sell an at-the-money option in the VIX in March and 30 days pass, even if the VIX cash underlying doesn't move or even rallies a little bit, it's possible that you have collected some delta from that trade because of the natural delta decay of the VIX option, the VIX futures. So yeah, you know what? Today the at-the-money is 30. In a month it's going to be 29. In a month it's going to be 28. In a month it's going to be 26. And you'll have sold this option and nothing happens and you make money off of delta.
Mark Phillip wants to know, are you sure the VIX option decays two times faster than normal options?
No, it's not faster, it's differently. Okay? It's differently. All right? It is multi-dimensional. Okay? So it doesn't decay twice as fast. It just has a different type of delta decay. Okay? It has a weird delta drift is what I would call it. You know, if you sell an at-the-money option in March, in a month, due to delta drift, even if the VIX cash doesn't change, okay, even if the VIX cash doesn't change, that 50 delta call that you sold is now a 40 delta call or a 45 delta call. Okay, it's different than theta decay. It's multi-dimensional. It is a very, very complex subject. I'm sure. Are you sure it decays twice fast? No, it's not. It's that it has two different types of decay that are working. All right. Now, the thing you've got to remember is that if the VIX does get a big pop, that decay isn't there, right? I mean, there's a reason why that contango exists. There are people that think the VIX is going to rally, or that fear is holding that up. Does that make sense?
David asks, is this a BS option? And I think BS stands for Black Scholes.
Well, I think it would go with the, I will see. I think it would be just the black model since it expires into futures, right? Well, sure, it's a Black Scholes model. You know, I'd have to go double check. I think you could use just about any model on here, out there. I mean, like Whaley would probably work. I think they're American style, so I don't think Black Scholes is a perfect model. I want to say it was Whaley or it was just the straight black model that does American style futures options. But that's just off the top of my head. Cox-Ross-Rubinstein might work. Trinomial might work. Quadnomial. Some of those binomial models would work fine too. I think and I'm not sure he meant Black Scholes, Chris.
I was giving him the benefit of the doubt.
I know. This is a very confusing option, all right? But it has some cool value And you've got to understand that something complex like this, that means that there are a lot of people that are trading it that don't understand it. When people don't understand something, it creates opportunity. Would you guys not agree with that? All right? What creates opportunity? All right? Risk. When risk isn't properly assessed, if you can assess risk better than somebody else, that puts you in advantage. Now, you can't assess risk probably better than many of the market-making firms, but you can certainly be better than everybody else out there. Some of these big fund guys, and you can certainly assess better than a lot of other retail traders that don't have a Chris Smith or a Mark Sebastian to talk to. Okay? So what I want you to remember is this is not the same as theta decay. It's a combo of delta drift and theta decay at the same time.
Yep.
And that's
Mark,
only when futures are in contango.
Mark,
Yeah,
you're being corrected. I think you said that VIX options were American style.
I thought they were.
And apparently they're European style. And I just confirmed that on SIBO.
Oh, okay.
So,
I apologize.
Black-Scholes,
Yeah.
I guess, does work.
Yeah, Black-Scholes will work fine then. That's fine. So, they are European style. So, anyway, we should probably get back to the presentation. I feel like this has gone off in a little bit of a direction. But, so the key to kind of this contango, all right, understanding this contango is that you have to know, what is going to happen, all right? Here's the problem, okay? If I throw a butterfly on in November on the 23 line and nothing happens in the cash market, what will happen to my underlying? It's going to fall, right? If I put on an at-the-money butterfly in November, okay, and the VIX kind of stays around 19 or 20, what's going to happen to the November future over time? It's actually going to fall toward 20. All right? It makes it a very unique income trade. All right? All right, any questions, any more questions on that?
Yeah, we got a few. Philip's asking, so is it better to sell VIX rather than buy the VIX options?
Yes and no. I think that when they're in a big contango like this, there can certainly be some value to selling VIX options, but I don't think it's a great traditional income product. Like, if you're going to trade a VIX condor, you have to have a very clear understanding of how the VIX is going to move. Does that make sense? You have to, you can't just trade the 15 delta put or the 20 delta put and the 20 delta call on the November contract month, because if nothing happens, the VIX is going to head toward 19, and that could be very well where you set up your condor. So,
Mark,
just kind of briefly,
we got a couple requests for a quick nutshell definition of contango.
Contango is when the front month futures are lower than the back month futures. Backwardization is when the front month futures are higher than the back month futures. And 75% of the time, the VIX are in contango. All right. So let's say we set up an iron condor strategy in the VIX in November, and we sold the 2018, and we sold the, or or here, yeah, we sold the 2018 and we sold the 27, or no, we'll do the 2119 and we sold the 27 30, or the 2629, sure. There we go, okay? What is going on? What is wrong here? Oh, there we go. Now, here's the issue, all right? You put this around where the current futures trading around 23, you put this around. Now, if we sit here and nothing happens, all right, as nothing happens, the price of the future, which right now is like 23.20, as time passes, you know, you've got this kind of falling price. Do you see what the problem, where the problem is if you don't know, if you don't set these things up properly? See, I think it's a really good credit. I think it can be a really interesting and exciting credit spread thing. And if you want to make bets on volatility and you know how to do it, this can be a really interesting product. I think it's a real tough product for, you know, butterflies and calendars and condors. But that said, if you can develop the right condor strategy, you can also do reasonably well. Does that kind of make sense, Chris? I know this is a really rich subject, and you know, I worry about making this presentation, but generally I assume the Option Club really knows what they're talking about, and so I don't mind throwing some really heavy stuff at them.
On that note, we've got one question here. It says, how long would it take for an average trader to understand this before they can trade?
You know what? Go to like Bill Luby's site, or sit down and, you know, work with a guy like me or something like that. You know, and do some really good reading. All right, read the entire contract specs, do some back trading. You know, who knows? Everybody's different. There's some people that are going to sit down and learn this right away. There's some people it's going to be a little harder. I don't know. What do you think, Chris? This is probably, you might be as you know, yours qualified.
Yeah, I think it really. I mean, this is not what the guy who's just starting with options needs to jump into.
No.
Yeah.
No. I'm going to get into where this does have value. All right. And for the the individual trader, but the guy that really wants to get good and wants to take bets on volatility, you know, you do a good month of kind of going through a bunch of back trading and seeing how how the product works, watching the movement in the options, learning upwards and backwards. I mean, you saw, I forgot that they were European style. Learning backwards and forwards the contract month and how the contract operates, and you can, you know, start making some certain types of bets on volatility. All right. Now, once you're getting into like unique condors, that's going to take a little more work. But that would be kind of cool. I think there might be some real money in that. I don't think even a lot of the market makers have a grasp on how this futures decay works. All right. Sorry if I'm coming. If this is, we do get into less complex stuff than this at Option Pit. But, you know, I think it's fun to really get into some of this stuff sometimes. And, you know, I just assume you guys are smart enough. I generally have found that when you throw out something difficult, people step up to the challenge. When you assume that they're, you know, too stupid, you make yourself dumber. You know, by me doing this, I have to force myself to learn more. Okay? I just realized, hey, you know what? I need to do a little more mess around with this stuff. I completely forgot their European stop. All right.
Quick question, Mark.
Yeah.
On the credit spread that you were showing, what month and delta typically works best?
You know what? If I knew the answer to that, I wouldn't be here. I'd be on what was the name of our island, Chris?
I can't remember.
Smith Bastion, I believe, or
something like that.
Bastion?
Yeah.
Or Sabith, something like that. You know, you've got to understand how general options work. You know, if you go closer in, you are going to be able to take that advantage of the decay, but you're not going to have as much time to be right. If you go further out, you're going to be a lot further out. You're going to be a lot more protected from any little spikes in volatility. But that decay is going to be a little slower. Generally, I think you're probably better off. If I had to kind of put a leg out there, I would say December would be an interesting month to do. Kind of depending what you're going to try and sell. Maybe even November. That it's weird because we've all seen this time decay graph. But the time decay graph where the at the money decays fastest. But it's weird because this at the money is constantly moving. So my guess would be second month out if I had to bet. But as you can tell, that's not going to be. I obviously don't do a ton of stuff with this. I use it in more the hedging. The VXX. If you want to make short-term bets on volatility, this is a decent product. It's the one that can easily see because one can easily see the underlying. Do not hold this more than for 5 days. All right. This has triple decay. It's got the rolling of the futures we talked about. It has the futures kind of drip. And it has, data decay in the options. This thing is just a complete nightmare to hold for any long period of time. And I really do think it's going to zero. And I do put my money where I own a bunch of puts. So let me just be clear on that. I own a lot of puts in VXX. All right, because I think it's going to zero. All right. VXZ, this is a much better product for hedging and trading. However, understand what it represents. It will not make wild movements of the VIX. It's better for long-term bets. It still has contango, and it's kind of hard to borrow, which can make it can have some weird effects. All right. I like it a little better if one has a long-term bullish volatility idea. But, it too has kind of a triple decay. It has a little bit of contango problem. It has this kind of the rolling between those different futures months. If you don't know what I'm talking about, go back and watch my other presentation. It has that kind of like slow decay, and then it has option decay. So there are a lot of different things going on there with the VXZ that make it kind of interesting to trade. All right, now, skew. All right, this is getting into the hedging. All right, now we've all heard me discuss the power of units, and buy units and they will protect you. All right, if you buy units, they will protect you from getting blown apart. Kind of true. All right, but they can be ineffective. All right, when skew is really steep. All right, downside put skew. When I say skew, I mean smile. All right, when downside put skew is really steep, some of the power of the unit can be lost. All right, this is because they already have some of that explosive gain value priced in. All right, so the protection ends up too pricey and too far away. All right, when skew is expensive, the VIX options or futures can be an effective way to hedge positions. Since, as stated, that futures are expensive and kind of hard to trade, we will look at expensive in terms of commission and hard to trade because nobody has a quote on them. We're going to look at the VIX options. All right, the front month options have the problem with the double decay. All right, the options decay and the futures decay. All right, it's really fast. They're still good if one thinks a short-term pop may happen. Back-month options have fewer problems and gain value reasonably well. All right, it's similar like the VXV in that it's not wild. All right, but it doesn't have, you cut out that kind of rolling problem that even VXV has. I think very, very long-term VXV may actually be going to 0.2. We'll see. All right, so setting a trade. All right, find the good month. Buy an at-the-money option. I really think the at-the-money option makes the most sense. All right, and then hold it till you unwind the trade. All right, so let's compare. All right, I want to show you this in live ball. This was in April. All right, notice, and this is kind of the upper 25%. Notice kind of the cheap downside of the range. Keep an eye on like where the vol lines up with kind of 931. Okay? And then we're going to kind of walk through the flash crash. Look at what's happening. And pay attention to June and May. All right? We're seeing this like creep up in volatility. All right? We're definitely higher. And then we have this flash crash. And then look at this explosive volatility in both June and in May. This is not the time to be buying units. All right? So if somebody had wanted to, so, you know, and I'll kind of show you. This is kind of neat. We're going to look at June when skew was really, really bad. I'm going to set up a really high probability condor so that, you know, nothing gets in it, nothing touches it. All right, that's going to be my goal. And I forget where we trade, but let me find a good day when we've already kind of dropped a little bit. I think, here we go. We'll do Monday, May 3rd, because I think we've already dropped off a little bit then. Or is it Wednesday? I know we see a kind of a sell-off. All right, so here we are it's May 5th. We've seen a little increase in skew and stuff, but nothing ridiculous. We're going to set a super wide condor, okay? So we're going to sell, you know, we'll sell 10 of the, you know, this is wider than I would ever do it. I just want to be out of the way. This is not, I repeat, not how I would set up a condor. However, this is how some people might teach it, all right? So then we go out and buy a cheap unit. Let's say we buy, I'm going to have to define options. I'll buy, let's put in the 950, 925, 925, 900, 850. All right. And you'll see how good a unit can be during that period of time. All right. All right, so let's buy a, you know, we'll just buy one 950 put. That's good enough. All right. You know, it's maybe a little more than we would have paid or blah, blah, blah. But you know what? Good enough. Now, here we are during the flash crash. We paid $3.70 for that put. That put is now $10. Okay? That's a nice purchase. That is what a unit is supposed to do. All right, it's supposed to really protect the position. Obviously, we've got crazy closing marks, so we're not going to even look at that. So here's Friday. All right, we're at the absolute low. You'll notice we actually made 268 bucks, and it's mostly because this unit really paid out. At this point, if you set up a trade like this and you don't take this sucker off, I will, if we see something like that and you end up money and you don't take this sucker off, you are going to have, I mean, I will personally drive to your house and, you know, give you a whack over the back of the head. All right? You know, now, here's the key thing, all right? What don't you want to do? All right, say, you know, we close this trade up. I'm going to just close this trade up. If I were to throw on a July position, on the 7th, let's say I'm the type of guy that says, you know what, I got the chutzpah, I'm going to sell a strangle into this thing. You will end up making money on this trade, trust me. All right, but here's the problem. Here we are at 800 and it's still $7. All right, you're 300 bucks away. All right, I'm going to, in order to find something cheap, I'll sell the, all right, we collect $2,300. So in order to get something cheap enough to insure, all right, define I'm going to go 700, 750, 650. I think we'll find something there. Any questions so far on what I'm doing?
I think we're good so far.
Great. Isn't this fun? I'm really surprised OptionView. We have not had one OptionView related incident so far.
Well, you just jinxed yourself now.
I totally did. So in order to find something that is affordable for me to hedge, I have to go to the 700s, which are 400 bucks away. All right? Now, I'm going to bring this thing to the 21st, and you tell me how much that 700 option that I bought for 320 really helps. What was it, the 20th? When do we hit the absolute? I want to say it was like 8:30 in the morning we hit the absolute low on the 21st, right? All right, so here we are. We're certainly lower. And look, you know, I've gotten a little value out of that 600. We've gotten a nice little skew increase. Oh, that can't be right. Yeah, maybe it is. We'll look at it at 2:30. We'll look at it on Thursday. Yeah, no, that was a bad print, you can see. So, literally, that put has gained, you know, 20 cents. It's done nothing for me. My condors work great. Okay? All right? But if I get rid of this put, all right, I'm in much better shape. I actually make more money, I think. Now, how would the VIX option have done, a long-term VIX option have done on Friday, May 7th? Let's see. First things first. What is our at-the-money option? All right. VIX is trading 40. Okay. But where are the options telling us the at-the-money is? It's lower than 40, actually. It's let's see, the 30s. It's telling us, I believe, that it's around 31 bucks. Take a look. The call, the 30 call is 570. The 30 put is 490. Okay? So our at-the-money option, the VIX July future is trading what? 30.80 or something like that. So I could simply just buy, if I wanted to buy, what I would do is I'd either buy an at-the-money option, or in this case, just to prove a point, I'll buy something with the exact same value. All right? And then I'll carry it forward to the 20th. Notice it actually outperformed the other option. If we had gone the other route and traded with the at-the-money option, you know, it's weird because you do spend more, but when you unload it, you end up getting a chunk of that back, so it's not quite the same. I actually like kind of, I think either of these work. Yeah, and you make, you know, you make a couple $100. Now you'll notice, where is the VIX trading now? The VIX July futures trading 34.90. And there you have it. You know, we've made 258 bucks. That was, you know, best I can tell, that was a better hedge than, that was certainly a better hedge than that extra unit. Okay? So now I'm going to take you to an even kind of more crazy example. And I'm just going to show you this. This is kind of an interesting thing. We're going to go to July. Or, well, we're going to go to June 30th, really. And I'm going to delete that. And we'll pull up the SPX. Now you notice we're lower. What I want you to do is pay attention to, I'm going to buy a cheap August option. And we're going to hit the absolute lows. Let me see. Let me find a little higher. I want you to really see this effect. Now we still have kind of, why would I need data? Chris, who needs data, right? Oh, perfect. All right. So we're going to go to the 28th. Now all I'm going to do is show you how. Perfect. All right. 2:30 in the afternoon on the 28th. All I'm going to do is show you kind of how a 750 put performs. That's something we would buy for insurance. Let's find something. We'll buy an 800. I think that's a fair purchase, don't you? All right, now we're going to hit our absolute lows on July 2nd. Happens to be my birthday. That's why I know. We are at the absolute lows that day, and our option didn't gain a single red cent. Okay, now, and here's the worst part. If I go forward a couple of days, that unit is now cost me 200 bucks. All right. Now I love units, and I would still do this over doing nothing. All right. Now, as a hedge, what if on the 20? You know, what if on the I think it was the 28th I was looking at, right? Yeah. All right, here we are. We've got the VIX options open. All right, where's our, we'll use September, mid-range. Where's the September futures contract trading? It looks like it is trading at 32.60, or 32, let's see, 560 minus 350. So it's 32.10, okay? So we buy one 32 call, or we could buy the 370 since that's the same price. All right, I don't mind. It's a little cheating, but it's close. It's a little worse than we would normally buy, but you'll see. All right, now watch. Here we are on the 2nd, and look, it's actually gained value. And here's the neat thing, and when we go a week later, it's still worth about what we paid for it. So when we've got these instances of really steep skew, the VIX option is going to be a much better hedge than you know, a standard unit. Still love units though. All right. Any questions on that?
There are a few questions. I maybe the, you know, for the sake of time, we can distill this down a little bit, because we're talking about, on the one hand, using units on, say, the index on the S&P 500 versus using the VIX options.
Right.
And as a rule of thumb, in terms of when to use one versus the other, is that being driven primarily by the skew on the SPX?
That's what I look at, you know, or whatever product you might trade. But if the SPX has insanely steep skew, everything has insanely steep skew, right? I mean, that is what everybody trades. Many people don't realize this, but there's probably more money running through the SPX in an hour than on the ISE in an entire day. I mean, it is crazy how much cash runs through that thing. So, yeah, generally, if you see a really steep skew, an insanely steep skew, we've just had an incredibly huge pop in volatility. VIX options, you're saying, why am I buying expensive volatility? Well, they're going to be a far more controlled purchase of that volatility than that downside unit, which is really rushed for when when things are scary. All right?
And when you're talking about buying the VIX option, you're looking at the at-the-monies.
Yeah. Yeah, at the money or just out of at the money. To make it apples to apples, I try to buy things that cost about the same. And, you know, worked out pretty well. Obviously, again, test before you do any of this stuff, right? Don't just blindly follow what I say. You got to learn. You got to be, you know, I can tell you about it. You've got to teach. You've got to teach. Either really get involved with someone like me to teach you, or to work with you to learn it, or learn it yourself. Right now, you now know of how this hedging works. you don't know how to do this hedging. All right. Well, let me kind of quickly summarize. All right. Units can get expensive. Learn the steps to trade the VIX. The VXZ and VXX options are better at gambling than hedging. The VIX options have double decay. The midterm options make the most sense for hedging. And remind me to tell you guys a little secret. This is kind of interesting. So I got a phone call from official name yet, doesn't have anything. They're starting an exchange to trade realized volatility. Really interesting. So they're like, you can trade realized volatility. So if I'm trading realized volatility on IBM in January 2011, I could trade this contract back and forth. It expires at the end of January. So the whole month, I'm trading volatility as that volatility is happening. It's really interesting. So on that note, do we have any other questions? Email, you can email me, Mark at OptionPit. You can call me. You can follow me on Twitter. And check out the podcast I'm doing now. It's sponsored by Options Express and Option Insider Radio. It's called The Option Block. And it's available on iTunes, so you can just download it and listen to it. And you get if you enjoy the sound of my gums moving, boy, you're going to like this podcast. So, all right.
All right, Mark.
Questions?
I think we've been doing a pretty good job of hitting them as they've come up.
Good. This is the type of presentation where you kind of have to do that.
Yeah, I agree.
Yeah. So, guys, I know this is kind of a deep thing, but I really do want you guys to, before you jump in, please, please, please learn the contract. All right? Oh, yeah, and make sure you check us out at optionpit.com. We got the website. I'm, doing my daily blog. I'm about to post a blog after this on, IBM, I think, and what their earnings, what the paper said, and should be exciting. So, do we have any questions? Or maybe I'll just talk about the NASDAQ and how much it's going to be up or down tomorrow. So, any other questions?
So they can find your blog at optionpit.com?
What? Yeah, it's optionpit.com. My blog's right there.
And where do they find your podcast?
It's available on iTunes under Option Insider Radio.
Okay.
And, I'm doing stuff all over the place for the next few weeks. I'm going to be, if you live in the Chicago area, I'm doing a presentation at the CBOE on Friday. You can email me for more information on that. I'm giving a presentation for Trade Monster on Wednesday. I'm going to be in Florida in North Fort Myers at the end of the month. So if you've got any interest in that, give me a call. So, Chris, every time I come talk to you guys, I enjoy myself immensely. So one of these days I'll have to come on and actually show people how to adjust and how to actually trade.
Oh, we just had one question that came up asking about
theoretical. Yeah.
About earnings plays, but we'll save that for another presentation, I think.
Well, no. What was the question? Just real quickly.
Can you give an example of how you play earnings through options on both sides?
Oh, Lord. That's like, explain to me the Bible. Or, tell me about the Constitution. Things like that. Or, Chris, can you explain to me the bar exam? No, there are ways to do it. One of the things that they found, Goldman Sachs, if you shoot me an email, I'll send you this research paper. Goldman Sachs found that, in general, income plays and straight volatility plays are ineffective into earnings. You basically have to be right. And the way I play earnings, and actually I'm going to talk about this on the blog tonight, is I try and read paper. And I'm going to point out in IBM what I was looking at. All right. All right. So, feel free to email me or give me a ring. All right. Chris, thanks so much for having me.
Mark, as always, it's a pleasure. Glad to have you on board. It sounds like you've got some new presentations that you're going to have to do for us.
Oh yeah, I think I'm going to have hopefully have a lot of things going for you guys. So if you guys, every morning I do this free pit report, the AM report. It's live. You can come and listen to me talk. I don't charge. And we do right now we're doing a trade. We're doing a lot. I'm trading an OEX condor, so you can literally see what am I doing to manage a condor. So if that's something you guys are interested in, you should definitely check it out. So, can I tell you anything more about what I'm up to? No, I'm hopefully you'll be good enough to have me back, and I'll come up with anything. You know what? Maybe we'll do it by request. So you guys shoot Chris an email, ask him what you want me to talk about, or tell him what you want me to talk about, and Chris and I will look them over and we'll pick one. How's that sound?
Amarat says he needs a beer.
Yeah, I need a beer too.
Yeah, that makes three of us.
All right. Well, too bad I'm in Chicago and you're in San Francisco. Otherwise, we'd share one. All right, guys. Again, thanks so much for listening.
All right, Mark. Thank you very much. You have a good evening.
You too.